This is Matthew Kratter from Trader University, and today I want to talk about the biggest Bitcoin miner in the world, probably going bankrupt. This is a company called 𝐂𝐎𝐈𝐍, and they announced yesterday that they won't be making payments on their debt and that they're rapidly running out of cash. So the presumption is that this is a company that is headed for bankruptcy or other restructuring. We can take a look at a chart of the stock, which basically peaked back when Bitcoin peaked back in November of 2021. It peaked around $14 a share, and yesterday fell 78% down to 22 cents per share. The stock is trading, as I said, like a bankruptcy is coming or a restructuring, and this is the way it usually takes place. The stock goes to zero, the current equity holders are wiped out, or mostly wiped out, and then the creditors and bondholders, the debt holders, become the new owners of the company, and they can choose to unwind the company or keep the operations going. It's important to recognize that Bitcoin mining is capitalism at work. There are no bailouts, there are no secret Fed meetings, there are no zombie companies being supported by the Fed. Bitcoin doesn't care. It's a sad day for 𝐂𝐎𝐈𝐍 investors. That's the ticker if you want to look it up, 𝐂𝐎𝐈𝐍. It's a sad day for 𝐂𝐎𝐈𝐍 investors. In related news, though, over in proof of stake land, we are seeing much more happiness because there we have the oligarchs, Vitalik, Charles Hoskinson, presumably continue to collect giant staking rewards from their ill-gotten pre-mined coins. And we all know that even if Vitalik violated the consensus rules of Ethereum, it's unlikely that his stake would get slashed. So this is what's very interesting to see. Proof of work, which is what Bitcoin runs on, Bitcoin miners, is a constant. You have this constant churn in the set of miners. The big miners from 5 years ago are no longer the big miners today, and the big miners from a couple months ago, like 𝐂𝐎𝐈𝐍, are no longer going to be around, presumably. Whereas with proof of stake, you don't have churn, you don't have capitalism at work. Instead, you have increased consolidation and centralization. If you're finding this video helpful so far, I just ask you to hit that subscribe button below this video. I think that seeing investments like this go sour is a good reminder that investing in the space is really actually simple. It's not easy, but it's simple. Don't buy altcoins, don't buy NFTs, don't buy alts just because they tell you that they're buying Bitcoin, like Terra Luna and Do Kwon were doing. Don't buy Bitcoin ETFs or trusts or other Bitcoin IOUs or other paper Bitcoin. Don't buy Bitcoin mining stocks unless you really understand this industry. You're probably better off buying your own Bitcoin miner because at least then there will be less operational risk if you know what you're doing. But if you're bullish on Bitcoin, here's an idea. Why not just buy Bitcoin? People always try to overcomplicate these things. BTC is amazing stuff. It's like a perpetual call option on its own price. It doesn't expire. There's no operational risk there because there's no corporation behind Bitcoin. So you just have to buy BTC, hold your own private keys, and hodl for the next decade. Don't lend it out. Don't try to earn interest on it. Don't lend it out to Celsius or Voyager, which you can't anymore because they're gone. Don't lend it out to BlockFi for interest. If you're making 100%, 200% a year on your money on average, you don't need to worry about interest income. That's a very fiat way of looking at the world. And especially don't leave your Bitcoin on the exchange after you've bought it, whether it's Strike, whether it's Coinbase or Kraken or Gemini or FTX or Binance. None of these exchanges are safe because not your keys, not your coins. Just hodl it yourself. It's all you have to do. Now, buying a Bitcoin mining stock, as I said, is a completely different kind of bet because Bitcoin miners, they make money from the spread between the marginal cost required to mine a Bitcoin and what they can sell that Bitcoin for on the open market. So if you invest in a publicly traded Bitcoin mining company, you're making a bet, not on the price of Bitcoin necessarily, but also on the related price of energy and the operational skill of the company, whether they're conservative enough or whether they are able to finance themselves in a sustainable way without taking on too much debt at the wrong time in the cycle. And many of these companies, as I understand it, even took on debt against their ASICs, against their Bitcoin mining machines, and used those as collateral. And it's always a very dangerous thing to collateralize your loan with a depreciating asset like Bitcoin miners are. The other thing, when you invest in a Bitcoin mining company, you're taking into account not just the future price of Bitcoin and that spread, but also the present and future energy prices, not just globally or in general, but for that particular Bitcoin mining company. Will they be able to continue to get electricity at however many cents per kilowatt hour. Bitcoin mining, you can think about it a little bit like owning an airplane. Let's say you buy an airplane and you're a single airplane company. The question, if you're going to go into this business, is can I fly enough passengers around and still make a profit after jet fuel and maintenance before the wings eventually fall off? Planes can be obviously refurbished and can last a long period of time, but even old Cessnas from the Vietnam War that are still being used to ferry passengers around, they eventually need to head to the junkyard, or the maintenance costs are so large that it's almost like buying a new plane. So Bitcoin mining is very similar because these ASICs, these Bitcoin mining machines, are depreciating assets just like airplanes are. And they break down over time, they get exposed to the elements, they get exposed to a lot of heat, etc. And the thing about these ASICs is the latest model is always the best and the most efficient, which is another thing which makes this nice and capitalistic, because it gives newcomers to the Bitcoin mining space a great advantage. Right now, you can go out and you can buy the latest Bitcoin mining machine, and it's probably better than most of the machines that even 𝐂𝐎𝐈𝐓 had, because they had older machines from over the years. So Bitcoin mining, proof of work, it's not like proof of stake where the incumbents get to just sit on their hands and do nothing. It's more like being in the commodity production business, which is a notoriously difficult area to invest in, commodity production, because you have these razor thin margins most of the time. What happens is the price, the marginal cost of production usually rises right to the point of the marginal price that you can sell the commodity for. And this is true for Bitcoin as well. You also have these boom and bust cycles. If you think about copper mining as a business, or gold mining, or even wheat or corn farmers, these are very, very difficult businesses to be in. And these groups normally need to take on a lot of debt in order to finance their equipment, for example, and because margins are so thin. And so if you need to take on a lot of debt because margins are razor thin, this can lead to bankruptcy if interest rates adjust in a way that's not favorable to you, or if that debt is not managed well relative to the interest payments you have to make, the principal payments, as well as your free cash flow. So the question now is, what happens to 𝐂𝐎𝐈𝐓? What happens to Bitcoin? It looks like 𝐂𝐎𝐈𝐓 has already dumped most of their Bitcoin. If you look at the 8K filing from yesterday with the SEC, the company says that as of October 26th, they only hold 24 Bitcoin compared to 1,051 Bitcoin that they owned back in September 30th, just a couple weeks ago, September 30th of this year. So these ASICs, these mining machines that 𝐂𝐎𝐈𝐓 has, they have their own machines, and then they have hosted machines, and presumably the people who own those hosted machines will take their machines back. But the core company ASICs, they may stay plugged in if creditors can foot the electricity bill, or they may get dumped on the market to pay back these creditors. It's really up to the creditors to decide. It's also up to the utility companies, I suppose, as well, whether they want to take the credit risk that their monthly electricity bills will get paid. So this is good news if you're in the market for a new ASIC. ASIC prices probably continue to plummet. Again, it's a very difficult business to be in. Meanwhile, though, the good news is Bitcoin doesn't care. If a lot of miners unplug their machines, the hash rate will fall. Blocks will then take more than 10 minutes to be produced or to be found. And then the Bitcoin software will adjust to make it easier for the remaining miners to mine a block, so that we can bring that average block time back down to 10 minutes. And this happens every 2016 blocks. So the smart miners who didn't go bankrupt and unplug and have to unplug or be forced to unplug, they'll see a boost in their profits, at least until the next difficulty adjustment. If this sounds like capitalism, it is because it is capitalism. It's not socialism. Bitcoin is a dynamic capitalistic system. It's not proof of stake, which is a socialist system. Also, the percentage of the total hash rate, which comes from publicly traded companies like 𝐂𝐎𝐈𝐓, just got a lot smaller as well, which I think is a good thing. My vision would be eventually everyone has Bitcoin miners in their houses doing various tasks, like attached to the water heater or something like this. It's a very decentralized thing, because if you have most of the hash rate coming through large public mining companies, this is an attack vector through regulation. It's hard to imagine exactly how it would work, because if these miners go rogue and they produce bad blocks, the nodes don't have to accept it. But I think it is, in general, a good idea to keep an eye on the percentage of the hash rate, the Bitcoin total network hash rate, that comes from publicly traded mining companies, especially if they're concentrated in certain countries like the US. These can be a regulatory or government attack vector. It looks like as of May of 2021, May of 2022, 17% of the Bitcoin hash rate came from publicly traded Bitcoin mining companies. And it looks like at that point, 𝐂𝐎𝐈𝐓 had the highest hash rate. So this is obviously going to be falling, especially if those ASICs get unplugged. So in short, a lot of people will read these headlines. They'll be very disturbed. They'll think somehow that the parent company of Bitcoin is running into trouble, whereas it's nothing like that at all. Bitcoin is a decentralized protocol. It's an open network. You can come, you can mine, you can run a full node. You can use the network. It's permissionless, and it's open to everyone. And it's open to smart people who know how to run businesses. It's also open to people who want to make a quick buck, like 𝐂𝐎𝐈𝐓, make some mistakes, and end up going bankrupt. This is what capitalism looks like. There's no Fed, there's no bailout funds, and this is how I think the new global currency should work and should be run. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.